Hello, you're watching the business headlines on HW News with me, Ali Azhar. What if I told you that there was a company whose financial data has been guarded and not revealed ever since it got nationalized in the late 1970s? And now, because it wants to raise money from the international bond market, it has been forced to reveal financial secrets held close for 50 years. This company is none other than Saudi Arabia's Aramco. The first official glimpse of Saudi Aramco's financial performance confirms the state-run oil giant, which produces around 10% of the world's crude oil, can generate profit like no other company on earth. Net profit last year was $111.1 billion, roughly 7,70,000 crore rupees, which is equal to the combined profits of behemoths such as Apple, Google and Exxon Mobil, which makes Aramco a super behemoth of an entity. Aramco also paid a staggering $102 billion in taxes to the Saudi government, and in spite of that managed to rack up a net profit of $111.1 billion. It also paid $52 billion as dividend to the oil-rich kingdom. The company, led by Amin H. Nasser, is preparing for acquisition of a majority stake in a domestic petrochemical company named Sabic for about $69 billion, and hence is planning to issue bonds in the international market to raise money for this acquisition. And therefore it was necessary for Aramco to disclose its financial data to investors after all these decades. However, the bond issue was Aramco's plan B. Its initial plan was to raise money via an IPO at a jaw-dropping valuation of $2 trillion. And if this target was achieved, the company would raise a record $100 billion by selling 5% stake, dwarfing the record $25 billion raised by Chinese e-commerce giant Alibaba in 2014. However, this valuation of $2 trillion was not received well by the international investor community and has prompted a delay in the IPO, and hence the bond issue was resorted to as a way of raising money for the acquisition of Sabic. The Kingdom of Saudi Arabia depends heavily on Aramco to finance social and military spending, as well as a lavish lifestyle of hundreds of princes, which adds to the financial burden of the company. Rating agencies such as Fitch and Moody had a go for the first time at Aramco after its financials were made public and gave it an A+ rating, which is the 5th highest rating, AAA being the highest rating, lower than that of other oil majors such as Exxon, Shell and Chevron. The risks cited were the strong links between the company and the kingdom and the influence the state has over its most important asset. Unlike Exxon or Chevron, Aramco's revenue streams are highly dependent on one country, and if any instability in the government is seen, such as in Iraq or Syria, Aramco could take a big hit. Another risk, since it is not diversified, is the company's fortunes rise and fall with that of the price of oil. In 2016, for instance, at a time of low oil prices, the company reported only a $13.3 billion in net income. In a landmark decision, the Supreme Court today struck down the RBI's controversial Feb 12 circular on defaulting companies, calling it illegal, in a decision that would have definitely rattled egos on Mint Street. The Feb 12 circular revamped the framework used by banks to deal with stressed assets with an outstanding loan of over 2,000 crore rupees. As per the circular, banks were asked to initiate a resolution plan even if a company is in default for a single day. Hence, banks would classify such default even by a day as an NPA and were given 180 days from the first day of default to finalize and implement a resolution plan. If they fail, the account must compulsorily be referred to for insolvency proceedings under the IBC code. The drawbacks of the Feb 12 circular were that it put a strain on the balance sheet of banks who were forced to classify the account as an NPA immediately, thereby increasing provisions and affecting profitability. The circular also does not differentiate between cases that became NPA due to poor management or due to external factors beyond the control of the entities, such as lack of power purchase agreements or PPAs in case of power companies, or delay in payment or adjudication of claims, etc. Another drawback was the Feb 12 circular made initiation of insolvency proceedings mandatory after the 180-day deadline, thereby taking away the discretion given to financial creditors under the IBC code. The striking down of this circular by the Supreme Court has come as a major relief to stressed companies, specifically power and sugar companies. The infrastructure, leasing and financial services or IL&FS scam was a huge one. It had built up a massive 91,000 crore rupees in long-term debt. Much of it was willful, deliberate and via fraudulent acts of its directors. Finally, when it defaulted on its obligation, it took the entire market down with it and caused a massive liquidity crunch in the market. Provident funds, pension funds, gratuity funds, mutual funds, public and private sector banks and retail investors who had placed their trust and invested in the company suffered. It was one of those companies, along with the likes of LIC and SBI, that had the tag too big to fail. But through fraudulent malpractice, it did. There were three main people who ran IL&FS: Ravi Parthasati, Arun Kumar Saha and Hari Sankaran. The Serious Fraud Investigation Office or the SFIO has arrested Hari Sankaran, who was the former chairman, in connection with its ongoing investigation, marking the first arrest in the fraud hit IL&FS. He has been arrested on the grounds of abusing his power through fraudulent conduct and in granting loans to entities which were not creditworthy or declared NPA and caused wrongful loss to the company and his creditors. The SFIO will hold him in custody and interrogate him till 4th April. Thank you for watching HW News. This is me signing off. Have a great day.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.